France has now withdrawn every last bit of its gold reserves that were held at the Federal Reserve. That's 129 tons, completely removed. And the reason they provided stands out as one of the most telling statements from a central bank in recent memory. Not for its candor, but for how plainly it rings false. At the very same time, gold, which had been trading at record levels above $5,500 per ounce, plunged by 20% in just a few weeks. It marked the sharpest single weekly drop since 1983, all while an active conflict raged in the Middle East, amid an oil price surge, and in the exact kind of conditions where decades of financial models, textbooks, and market history would predict gold should rise. These two developments aren't separate. They're visible pieces of one larger narrative. That narrative centers on who really influences the gold price, the methods they use, the reasons for pushing it this way right now, and what the major players who grasp this market are actually doing behind the scenes. While many investors focus on the wrong issues, everything I'll outline here comes straight from openly available information. Exchange reports, central bank disclosures, vault stock levels, and capital movement records. The challenge isn't that the details are hidden. It's that they're scattered across different sources and contexts, with few people linking them together. That's exactly what I'll do here. The gold market operates on two separate levels that most people mistakenly treat as one. Mixing them up is probably the costliest error an investor can make. The first level is the paper market, centered on the COMEX futures exchange in New York. There, contracts each representing 100 ounces of gold trade non-stop among hedge funds, trading algorithms, and major banks. This is the arena that determines the prices you see quoted everywhere. The key detail that shifts the whole picture: roughly 95% of these COMEX contracts never lead to any actual gold being delivered. They're essentially paper positions, and their total scale far outweighs the real gold available for handover. This isn't hidden information. It's simply how today's gold pricing system is built. The second level is the physical market. Think of the LBMA vaults in London, the Shanghai Gold Exchange, and direct central bank movements. It's less fluid, less in the spotlight, and rarely highlighted. Yet this is where the genuine long-term direction shows itself. Here's what unfolded once the Iran conflict erupted. The CME Group changed its margin rules, switching from set dollar amounts to a percentage of the contract's value. It may sound like dry procedure, but it wasn't. As gold prices climbed, required margins automatically increased too, a built-in mechanism that intensified pressure within the market setup. Then, over the next 2 weeks, margins were hiked 3 more times. This created a harsh imbalance. Giant players like JP Morgan, Goldman Sachs, and HSBC, with essentially bottomless resources, handled the increases easily. For smaller hedge funds and individual futures traders, though, it was make or break. They couldn't come up with the extra collateral, so they had to unload positions. That selling pushed prices down further. Lower prices then set off margin calls on other leveraged trades, sparking even more forced sales. Prices fell more, triggering additional calls. A classic liquidation spiral. It was a self-feeding mechanical loop that had zero connection to gold's true underlying worth. Now consider the clear follow-up. Who gained from this? The deep-pocketed institutions that rode it out could scoop up what the smaller players had to dump at fire sale levels. This is classic institutional wealth shifting, refined over decades. The exchange framed it as a standard check on volatility. Technically accurate on the math, but the result, smaller players wiped out, bigger ones building positions, was baked into how the change was structured from the start. That was one driver. 3 more struck at the same moment. Turkey relies on imports for about 90% of its oil. When the Middle East tensions sent oil above $110 a barrel, Turkey's energy costs jumped by billions virtually overnight. With the lira already shaky and reserves tight, the country had a stark decision: face a currency meltdown or offload gold. Turkey unloaded between 60 and 120 tons in a short span. For perspective, global gold ETF outflows in that window totaled around 43 tons. Turkey's moves alone surpassed all the selling that headlines blamed for the drop. Gulf nations dealt with a similar but parallel issue. Their currencies are pegged to the dollar, so they need dollar reserves. Those are usually topped up by oil sales. When the conflict hampered shipping through the Strait of Hormuz, export income dipped while the peg requirements stayed fixed. They bridged the shortfall by selling gold. The recorded outflows from London LBMA vaults matched the scale and timing of substantial Gulf state disposals. The third driver involved the dollar itself, and this part often surprises people. In sudden, intense geopolitical crises, the usual gold-dollar link flips. As major risks hit without warning, money pours into U.S. treasuries for safety. That boosts the dollar. And because gold is quoted in dollars, a firmer dollar puts downward pressure on gold prices for buyers outside the U.S. The chain worked this way. Conflict lifts oil, oil raises inflation fears, the Fed holds back on rate cuts in an inflationary setting, higher U.S. rates pull in global money, the dollar firms up, and gold drops. Trading algorithms set to sell on rising real yields kicked in heavily. The loop reinforced itself. Then came the fourth element, the one that lays bare the deeper strategic picture. Those 129 tons of French gold, stored at the Federal Reserve since the 1920s, were fully cleared out between July 2025 and January 2026. The official account from the Banque of France? The gold was outdated and didn't match today's market standards, so they sold it in New York and purchased suitable gold in Europe, now all kept in Paris. That story falls apart under examination. In every earlier case of pulling gold back from New York, Germany's well-recorded effort from 2013 to 2017, plus moves by the Netherlands and Austria, they simply shipped the bars physically. Standard procedure. No one sells their own gold and then buys replacements. That's not repatriation. That's cashing in a claim and acquiring gold elsewhere. You take that route only if actual physical handover isn't feasible, either due to impossible logistics, which isn't the case for bar shipments like these, or because the gold you thought you owned can't actually be provided. To be clear, this remains an interpretation, not proven fact. The reading is that France asked for its gold back, discovered physical delivery couldn't happen, settled for cash instead, and worked with the Fed on an explanation that called it a standards update rather than a failed handover. Both sides had strong reasons to go along with that version. The Fed avoids admitting any shortfall, and France avoids any hint that its reserves might have issues. What's not interpretive is what followed. Leading German economists and politicians quickly started pressing publicly for Germany to bring its own gold home from the U.S. A former Bundesbank economist stated outright that keeping gold in America now carries geopolitical risks. Germany still has about 400 tons at the Federal Reserve. The discussion is live and growing. This echoes 1965, when de Gaulle sent a French warship to New York to swap dollars for gold under Bretton Woods. Other countries joined in. The gold drain grew so heavy that by August 1971, Nixon shut the gold window, the Nixon shock that ended Bretton Woods and launched the dollar-based reserve system that shaped global finance for the past 50 years. I'm not forecasting the same outcome, but the core tension, other nations losing trust in the U.S. as a safekeeper of their gold and the fallout from that erosion of trust, follows the same underlying pattern. While the paper side was tumbling, the physical side told a different tale. COMEX registered stocks, the gold actually ready for delivery, dropped by about 25% during the paper price slide. Real metal was exiting the system faster and faster, precisely when the paper price hit its lowest. Physical gold doesn't vanish just because someone sells a futures contract. The bars are tangible. The paper obligations aren't. Meanwhile, in China, an event barely mentioned in Western financial coverage took place, one I see as among the biggest gold market shifts in the last 10 years. Chinese regulators greenlit 10 major insurance firms, including giants like PICC and China Life, to put as much as 1% of their total assets into gold. 1% may sound small, but these are organizations handling trillions in renminbi. The potential buying power from this alone comes to roughly $27 billion. Several of the firms have already started putting money to work. The sector hasn't come close to hitting its cap. Should the program expand to more companies, as the rules clearly allow, the impact would grow even larger. Chinese gold ETF inflows held steady the whole time North American ETFs saw heavy outflows. The premium for physical gold in Shanghai over the COMEX paper price stayed high. The message from China's physical market was unmistakable. At these reduced levels, big institutional buyers in the East were loading up with force. This highlights the deep imbalance shaping the current environment. Western paper traders, squeezed by margin demands, were dumping. Eastern physical buyers, unleveraged with extended time frames, were collecting. The price that had Western holders in a panic looked to Chinese insurers and Asian central banks like a chance to buy on the cheap. Market analysts call this the shift of assets from weak hands to strong hands. Weak hands rely on borrowed money and can be compelled to sell. Strong hands own outright, view dips as buying chances, and can afford to hold long term. What played out was a structured large-scale handoff. The structure came via margin adjustments. The winners were those who either shaped the conditions or could endure them. Stepping back to the wider strategic view, because grasping single incidents matters less than seeing the system behind them. In February 2022, the United States froze roughly $300 billion in Russian central bank assets. Whether that was warranted is beside the point. The lasting impact, quietly echoing across sovereign wealth funds and central banks worldwide ever since, was proof that dollar-based reserves aren't untouchable. They can be locked away. Access depends on your political alignment with Washington. Countries now ramping up gold purchases at the fastest rates in decades. Poland, Kazakhstan, Brazil, India, China aren't basing it on forecasts of gold price gains. They saw Russia's experience and reached a logical takeaway. If your country's wealth sits in a system run by a possible rival, that wealth isn't entirely under your control. Physical gold stored in your own facilities, free from any other party's say-so, is the sole reserve asset that can't be frozen, taken, or restricted by external politics. This is de-dollarization in practice, not driven by ideology or hostility toward America, but by straightforward sovereign risk assessment in light of a clear example. The knock-on consequences go deeper because the short-term price swing isn't the real tale. COMEX registered stocks continue to shrink. Physical buying from Eastern institutions and state accumulators keeps climbing. The group of leveraged Western paper players vulnerable to margin calls is limited, and each wave of liquidations makes it smaller. Eventually, the paper market's capacity to maintain a price detached from physical supply will hit its built-in ceiling. When that limit kicks in, the catch-up will be swift and significant. The Fed finds itself stuck. Inflation blocks rate cuts, yet softening growth calls for them. But with $38 trillion in U.S. government debt, much of it needing rollover at today's rates, high rates create unsustainable fiscal strain that can't last. The eventual path points to lower real rates, easier monetary policy, and a softer dollar, the setting where gold's extended upward case comes fully into play. The main mental hurdle is this: gold fell 20% off its peak. That's tangible and painful. But the question that counts is whether the core drivers shifted at all. Did America's fiscal deficit shrink? Did global central banks stop adding to their gold? Did the physical market flash any surplus? Did de-dollarization slow down? None of that occurred. What did happen was a technical squeeze in the leveraged paper arena, boosted by government-mandated selling tied to an energy crunch, and routed through a brief dollar rally. The underlying case stayed intact. Over a longer view, the dip simply offered more room to build positions at better levels. The participants set to gain from the coming alignment between paper pricing and physical supply aren't those glued to daily COMEX quotes and knee-jerk reactions. They're the ones who distinguish a short-term mechanical paper disruption from a lasting shift in the bigger picture, and who have the steadiness not to mix the two up. Focus on the indicators that truly count: vault levels, physical buying figures, state accumulation trends, and the gap between paper and physical. Not the constant chatter from a leveraged paper setup deliberately built not to mirror the real asset it's meant to value. France has relocated its gold to Paris. China has permitted its insurance sector to establish the biggest gold holdings in its history. Central banks throughout the non-Western sphere keep adding well over 1,000 tons annually. The CME tweaks margin rules in ways that clear out leveraged smaller players and let strongly funded institutions gather at bargain levels. These aren't isolated incidents. They're the actions of sophisticated players who recognize that the worldwide monetary framework is in the opening phase of moving away from single currency dollar leadership toward a more balanced reserve setup, with physical gold taking on greater importance than any time since 1971. No one knows if that shift wraps up in 5 years or 20. What is clear is that the momentum comes from pressures that aren't fading, they're gaining strength. The paper market is mounting a defensive effort against a physical reality that's growing harder to contain. The shift is underway. It's out in the open. And it's unfolding now at the very levels the paper suppression dynamic has produced.